Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Steve Sosnick, chief strategist at Nasdaq listed Interactive Brokers, to discuss trends that we're seeing in the Nasdaq-100 Volatility Index, better known as VOLQ, and potential strategies to trade those trends. Steve, it's great to see you as always. Happy New Year. Welcome back to Trade Talks.
It's a pleasure to be here, Jill. Happy New Year to you too.
Thank you. And let's provide the audience with an overview of VOLQ and how it's different than what we commonly hear with the VIX as the volatility index.
Yes. The key thing to remember with VOLQ as opposed to VIX or its brother VXN is the methodology is different. VOLQ basically takes a look at the three strikes nearest to the market in either direction. And that gives you a much purer look at the at-money volatility than you would with, I'm just going to call it generically VIX or VIX methodology, than you would with the VIX methodology. What they're trying to do is give you give the 30-day look ahead, what the market's best estimate is, but they're using a blended rate of above market, below market, at market options. And the problem you get into there is it doesn't necessarily jibe with what you're seeing in terms of actual historical or realized volatility, or even at money implied volatility. The reason being, you've got below market options, markets have a skew, where below market options tend to have a higher implied volatility than above market options. The reason for that is there's usually some demand for protective puts. That demand can vary. And there's usually natural writers of above market calls, buy right strategies, etc. When you blend them together, it doesn't, sorry, go ahead, Jill.
When you talk about the different methodologies, do they move differently then? Can the VIX, for example, be up one day and VOLQ down the other, or do they typically move in lockstep?
They tend to move in lockstep, but there's other variables influencing the, I'm going to just compare VIXN and VOLQ because that's ultimately where I'd want to go, is with the VXN, which uses that methodology of at money above market, the range of options, versus VOLQ, which is a more defined index and a more defined look. You get some variability because markets, the skew can change. Skew is not fixed. Right now, you've got skews doing some crazy things in a sense of it's flatter than normal because, it has been flatter than normal because you've had this tremendous demand for above market call options, particularly from individual investors. That's not a bad thing, but what it does is it doesn't really balance out with the below markets. So you can get them moving in they'll tend to move in the same direction. It's very hard to imagine a scenario where you'd have at money vols going down and then, the skews moving enough to move it up. But what you get is it's not as pure of a number because you have this blend in there. And that's really the difference. And that's where I think that's where traders should be looking for with the strategies, because it's a way, if you were to spread the two, you can sort of isolate the at money volatility of VOLQ versus what I'm going to call the extraneous volatilities. Not that they're unimportant, but in terms of a pure calculation, they muddy the water a lot. But you can start to spread the two once you get into that mindset.
Right, and if we take a look at some potential strategies, of course, right now with VOLQ, only the futures are trading on it, but you can also use that as an indicator if you're looking at a trade in, the triple Qs, or if you want to use Nasdaq-100 options. We finished off the year so strong with the Nasdaq-100 significantly outperforming the other indexes, and there is this expectation that things could get back to normal once the vaccination is through the system and so forth, but of course, that's a few months out. So what are some potential strategies that you'll be looking at as we kick off 2021?
Well, one of the things that it does track very well is the at-money volatility in either the NDX index options or the QQQ options. And really VOLQ tracks that 30-day historical, the 30-day implied rather, quite well, which is good to see because the VIX future is a very popular strategy. So it's tough to trade VIX futures versus QQQ because you're in futures in one place and cash type of options in another place, so you can start to spread them off against each other, and effectively do a pure Nasdaq VIX type of spread. That's one potential strategy. And the other one would be, if you prefer using the futures and prefer rolling via futures, it's potentially a bit cleaner than QQQ, because you sort of have that 30-day roll rather than having to pick the right QQQ option. Now, that said, there's so many settlements, there's so many strikes on QQQ, that can make it in some ways easier to do it in QQQ. But the difference being, what is at money one day in QQQ is not necessarily at money the next day in QQQ. As we've seen, particularly last month, if you bought at money calls in QQQ, they were in most cases in the money calls within a few days or a few weeks, and so that changes your volatility picture somewhat. So, do you continue to roll those so that you have at money exposure? If you have VOLQ futures, you don't have to worry about it, because the contract is sort of moving along with at money in a way that you would have to do manually if you were doing QQQ or even NDX index options.
All right, Steve, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.